I want you to imagine just for a second that you are preparing for this massive medieval battle.
Okay, I'm picturing it.
Right. So you really want to be safe, obviously. So you put on a chainmail shirt, which, makes total sense. That's good baseline protection.
Yeah, standard issue.
Exactly. But then you're like, I need more. So you strap on heavy plate armor over the chainmail. Okay, you're feeling secure.
And sense to double up.
Right. But then you grab this massive, like floor-length, solid iron shield. You are completely protected from literally every possible angle.
Right, nobody is getting through that.
But there is a catch. You are now so weighed down by your own protection that you can't even swing your sword. Like, you can't even walk. You just immediately fall over in the mud.
Right, and the sheer weight of your own defense mechanism becomes the exact thing that defeats you.
Yes, exactly.
It's this illusion of safety that ends up creating a very real vulnerability simply because you just overdid it.
And welcome to today's deep dive, where we are taking that exact concept and applying it to your money and your business.
It's a huge topic.
It really is. Today, we're pulling from a massive stack of research, including the original writings of some legendary investors, modern ETF overlap data, and even institutional research briefs from groups like Adipar.
There's a lot to cover.
There is. And our mission today is to investigate one of the most fundamental rules of finance, which is, don't put all your eggs in one basket.
Yeah.
We are exploring the exact point where that seemingly bulletproof advice actually turns toxic.
Because it is a critical line to identify. I mean, crossing it doesn't just mean you stop making progress.
Right.
It means you actively start damaging your own potential.
Yeah.
And that's true whether you're running a massive multinational corporation or just, managing your own retirement account.
Okay, so let's unpack this. Because there is an actual term for this phenomenon in our sources, it's called diworsification.
Such a great word.
It is. It's a portmanteau, literally mashing the words diversification and worse together. And it was actually coined by the legendary investor Peter Lynch in his 1989 book, One Up on Wall Street.
Yeah, and to really understand why that word carries so much weight, you have to look at Lynch's track record. I mean, he managed the Fidelity Magellan Fund from 1977 to 1990.
Which was a wild time in the market.
Oh, incredibly turbulent. But during that time, he grew the fund's assets from $18 million to a staggering $14 billion.
Wow.
Yeah. And he didn't do it by just, riding a broad market wave. He averaged a 29% annual return for his investors over that entire period.
That's just insane.
It is. So, when someone with that kind of historical success coins a term, the financial world takes notes.
Right, they pay attention. So diversification happens when adding more investments or expanding a business into new ventures actually reduces your overall performance.
Exactly. It adds complexity without adding any real value.
And ultimately destroying your risk-adjusted returns. It is the exact moment when diversification stops being a shield and starts being that heavy, paralyzing suit of armor we talked about.
Which is a trap that, honestly, even the smartest people in the room fall into constantly.
Yeah, and to really understand how diversification ruins an individual's portfolio, we first need to look at how it destroys billions of dollars in the corporate world.
Oh, the corporate examples are the best.
They really are, because when massive companies forget their core competencies, the results are, well, honestly, they're kind of hilarious.
Yeah, they really are.
I was reading through the corporate case studies and the sources, and some of these blunders are just totally bizarre.
It is a fascinating masterclass in what happens when a company tries to be everything to everyone, right?
Yeah.
Instead of just being exceptional at one thing.
Okay, so get this. BIC, right? The company famous for cheap, reliable, disposable pens and lighters.
Sure.
They decided they needed to expand their product lines, so they launched disposable underwear.
I mean, what were they thinking?
Right. And if that wasn't bad enough, they also launched a cheap perfume. Because, when you think of luxury fragrance, you definitely think of a disposable plastic ballpoint pen.
It's just so out of touch. They fell in love with the concept of disposable and somehow convinced themselves that that was their core competency.
Instead of just, making plastic tubes.
Right. Instead of understanding that their actual skill was cheap plastic injection molding. And the crazy thing is, they weren't alone in this kind of delusion.
Oh, not at all.
Look at Harley-Davidson, the absolute epitome of rugged, leather-clad motorcycle culture. They decided to develop a men's perfume.
Wow.
And, even more baffling, a cake decorating kit.
Wait, really? A cake decorating kit?
Yes. from Harley Davidson.
I can just picture a bunch of bikers sitting around a dive bar, like critically analyzing the frosting rosettes on a homemade cupcake.
It makes absolutely no sense.
It really doesn't, and it just keeps going. Cosmopolitan magazine tried selling yogurt.
Oh, yeah?
And the absolute winner for me, hands down, is Colgate.
Oh, the toothpaste company.
Yes, the
Yeah.
toothpaste company. They allegedly tried to sell a line of ready-made meals, specifically a beef lasagne.
Which is just an incredibly visceral brand clash. I mean, think about it. When consumers see the Colgate logo, their brain instantly expects the taste of minty toothpaste.
Yeah, exactly.
So putting that logo on a box of frozen beef lasagne is a neurological short circuit. The branding literally fought against the product.
It's like an elite marathon runner suddenly deciding, you know what, I need to be a competitive powerlifter.
Right.
You want diversifying your athletic skills, you're just ruining your marathon times. You're adding all this heavy, bulky muscle you absolutely do not need for your actual race.
And what's fascinating here is the underlying psychology driving these decisions. Like,
Yeah.
why do rooms full of highly paid, highly educated executives make these choices?
Ego.
Exactly. It usually boils down to ego and this phenomenon called empire building.
Ah, right.
Often, management sits on a business with a massive moat, meaning, a competitive advantage that protects them from rivals, like a castle with a deep moat around it.
Right, like being the absolute best at making disposable lighters.
Yes. And that core business generates huge amounts of cash. But instead of returning that cash to shareholders, the executives get bored.
They want more.
They want to oversee a sprawling, multi-industry empire rather than just running a very profitable, focused pen company.
Which completely violates Warren Buffett's famous advice. He has this great quote where he basically says, know your circle of competence and stick within it. The size of the circle isn't very important, but knowing the boundaries is vital.
Because when you step outside that circle, you aren't diversifying. You are actively gambling in an arena where you have zero analytical edge.
Yeah. And while the Colgate lasagne is funny, the financial consequences of this are terrifying when you look at the big leagues.
Oh, they are devastating.
The sources highlight some of the most disastrous M&A mergers and acquisitions blunders in history. Let's look at the AOL and Time Warner merger in January 2000.
It's a classic disaster.
It was a $350 billion deal. Time Warner, this historic media giant, merged with AOL, an internet provider completely reliant on dial-up connections. And the wildest part, they did the due diligence over a single weekend.
It was the absolute height of the dot-com bubble. Time Warner management was terrified of being left behind in the digital age, so they just panicked.
Right.
They merged with AOL to get internet distribution. But the supposed synergies never materialized because the mechanics of the businesses were just fundamentally incompatible.
Oil and water.
Exactly. They had massive culture clashes between old-school media executives and fast-moving tech guys. Plus, AOL's dial-up model was already becoming obsolete as broadband rolled out. It is still widely regarded as the biggest destruction of corporate wealth in history.
It's just wild. Then you have Hewlett-Packard acquiring Autonomy for $11 billion in 2011.
Another huge mistake.
Right. HP wanted to get into the sexy data analytics business. But HP makes physical hardware, printers and servers. Autonomy made complex, unstructured data search algorithms.
Completely different worlds.
Totally. HP's global sales force literally didn't know how to sell high-end enterprise software. Just 1 year later, they had to write down the value by $8.8 billion. It just vanished.
You're just gone.
Or look at John Deere, the tractor company. They spent 2 decades trying to run a healthcare business before finally throwing in the towel and selling it off in 2006.
And in all these cases, they took capital that could have been reinvested into their core manufacturing strengths and threw it into complex, unrelated fields where they were hopelessly outmatched by specialized competitors.
Okay, so it's really easy to laugh at corporations for losing billions, but retail investors are essentially making the exact same mistake right now without even realizing it.
Oh, absolutely. Every single day.
Which brings us to the math. Because if massive corporations with armies of analysts fail this spectacularly when they over-diversify, how does the individual investor sitting at home trying to manage their 401k figure out the limit?
It's a great question.
Because I'd imagine if you're managing your own money, you need to hold at least 100 different stocks to truly insulate yourself from a market shock.
Well, that is the common intuition, but the mathematical reality is surprisingly different.
Oh, really?
Yeah, this is rooted in modern portfolio theory, or MPT, pioneered by Harry Markowitz in 1952. Markowitz mathematically proved that you can achieve an optimal portfolio by diversifying across assets with different risk and return characteristics.
Okay.
But later academic studies, like the ones by Evans and Archer in 1968 and Mears-Statman in 1987, they ran the numbers on random portfolios and put a very clear, strict numerical limit on this protection.
So it's not 100. What is the actual limit?
The math shows that the vast majority of risk reduction is achieved when a portfolio hits about 20 to 30 individual securities.
Wait, just 20 to 30? That feels incredibly low.
It does feel low, but you have to understand the goal here. The goal of diversification isn't just to lower risk to zero. It's to improve your Sharpe ratio. Think of the Sharpe ratio like miles per gallon for your money. How much return are you getting for every unit of risk you take on?
Ah, okay.
Once you have 20 to 30 properly selected stocks, the math shows that adding a 31st or a 50th or a 100th stock does almost nothing to further reduce your overall risk.
The curve just flattens out.
Exactly. The risk reduction curve goes almost entirely flat. You stop gaining protection, but you start diluting the gains of your best performing stocks.
But wait, let's look at this practically. Doesn't common sense say holding 20 tech stocks is highly diversified because it's 20 totally different, distinct companies with different CEOs and products?
This raises a really important point, and it highlights the most common trap retail investors fall into. Diversification is not a function of the raw quantity of assets you own.
Right.
It is entirely about the interconnection of those assets. In finance, we call this correlation.
Like how they move in relation to each other.
Exactly. If you own 20 different tech companies, they are highly correlated. They all rely on the same silicon chip manufacturers like TSMC. They are all highly sensitive to interest rate hikes.
So they move as a pack.
Yes. If the tech sector takes a macroeconomic hit, all 20 of those stocks are going to crash simultaneously. You own 20 things, but you have zero effective diversification.
So if we go back to the medieval armor analogy, holding 20 tech stocks is like wearing 20 helmets but completely forgetting to put on a chest plate.
That is a perfect way to visualize it. You are hyper-protected against one specific blow and completely exposed everywhere else.
So what's the alternative?
True diversification is holding non-correlated assets. An investor holding just 3 low-cost index funds, say, one for the total U.S. stock market, one for international stocks, and one for the total bond market, is infinitely more diversified than the person holding 50 different tech stocks.
Because they react differently.
Right, because when U.S. equities take a massive dip, bonds historically tend to hold steady or even rise. One zigs while the other zags, which smooths out the whole ride.
Which sets up a massive trap people are falling into right now. Because we are currently living in the era of the ETF, the exchange-traded fund.
We really are.
People log into their brokerage apps, buy a handful of ETFs, and think they're perfectly safe. But they're actually falling into a modern, disguised form of diversification.
It's a huge problem.
And here's where it gets really interesting. Let's look at the data on ETF overlap from the sources.
This is critical for anyone managing their own money today to understand.
So an investor might look at their portfolio and say, okay, I'm being smart. I own a broad S&P 500 ETF to capture the whole market. And I also bought a NASDAQ 100 ETF because I want some aggressive tech growth.
Sounds reasonable, right?
Right. They feel incredibly diversified across hundreds of companies.
Okay.
But if you look at the data from the ETF Research Center, the SPY, which tracks the S&P 500, and the QQQ, which tracks the NASDAQ 100, have a massive 53% overlap by weight.
And if we connect this to the bigger picture, you really have to look at the mechanics of market cap weighting. These indexes aren't just equal slices of 500 companies. They're weighted by the total size or market capitalization of the company. Because tech giants like Apple, Microsoft, and NVIDIA are valued in the trillions of dollars, they take up massive outsized slices of both of those ETFs.
So you aren't actually diversifying. You're basically just buying the exact same 5 mega cap companies twice under 2 different labels.
Exactly. And this leads to a phenomenon known as closet indexing. Investors keep adding more and more thematic ETFs to their portfolio, like a global equities ETF, a sustainable energy ETF, maybe an AI ETF.
More is better, right?
They think so. But because these global mega caps dominate almost every index, the investors unknowingly concentrating all their risk right back into a handful of tech stocks.
And you're paying a premium for the illusion. Thematic ETFs usually carry much higher fee structures than a basic index fund.
Oh, way higher.
So you are paying multiple layers of management fees to basically just mirror the exact same market average, all while thinking you have this sophisticated protective shield.
The RV market analysis in our sources breaks down the danger here beautifully.
Yeah.
They point out that even if you just hold a standard 500 stock index, you might still be heavily concentrated.
Because of the top-heavy market.
Precisely. In today's top-heavy market, the top 10 stocks in that index often make up 30 to 40% of the total weight. So that feeling of comfort you get from owning 500 companies is largely a psychological illusion.
Wow.
The vast majority of your portfolio's success or failure is riding on just 10 companies.
It's the ultimate illusion of safety. You technically own 500 eggs, but 200 of them are crammed into one tiny fragile basket sitting right on top of the pile.
Such a good way to put it.
And when you dilute your portfolio with dozens of overlapping ETFs, you just ensure that your best performers are dragged down by the sheer weight of all your average or underperforming assets.
You guarantee yourself a mediocre return.
Right. You elevate your costs and you maintain a highly concentrated risk profile.
It is the textbook definition of diversification applied to the modern retail investor.
Okay, so this trap is clearly destroying returns for regular folks on trading apps, but it isn't just an issue for retail stock traders. It hits the institutional level too.
It really does.
Let's look at alternative assets like private equity. I'd assume a massive pension fund with billions to manage would just buy like 50 different private equity funds so their risk is spread out as much as humanly possible.
Well, that sounds logical on paper. But the Adipar research brief provides some fascinating insights that prove that strategy is deeply flawed. And it comes down to understanding how private, commitment-based asset classes actually function.
Right, because buying private equity works very differently than buying a stock on an app.
Completely different.
If a pension fund commits $10 million to a private equity fund, they don't just hand over a briefcase of cash on day one. The fund calls that capital over a period of maybe 5 to 10 years as they go out and find private businesses to buy.
Which creates a massive structural cash management problem for the investor.
Yeah.
You have to keep that $10 million liquid and ready to go for when the fund manager calls it.
Because if you don't have it,
If they call the capital and you don't have it, you default, and the penalties are severe. But while that cash is just sitting there in a safe, highly liquid account waiting for the phone to ring, it's earning very little interest.
it might even be losing purchasing power to inflation.
Exactly. This dead weight is known as cash drag.
So how do elite institutional investors solve this cash drag problem? Do they just load up on tons of different private funds?
They try, but the Adipar data shows there is a very strict Goldilocks zone here, much like the 20 to 30 stock rule we discussed earlier.
Okay, what's the zone?
If you go from holding one private fund to 3, you drastically cut the volatility of those capital calls in half. It smooths out the timeline and massively improves your ability to manage that cash buffer.
So 3 funds is good, but what happens if I use that pension fund logic and buy 10 or 15 private equity funds?
You fall right back into the diversification trap. The Adipar study shows that once you go beyond 4 to 6 private funds, you trigger over-diversification.
How does that hurt you exactly?
It destroys your upside. You have to understand the difference between alpha and beta in finance.
Break that down.
Alpha is that market-beating outperformance that you pay huge premium fees to a private equity manager to achieve. Beta is just the standard average return of the broad market.
Right.
If you hold 15 private equity funds, their individual big wins and big losses just cancel each other out. You end up with standard average beta performance. But you are still paying massive premium alpha fees to 15 different managers.
Oh, wow. You've essentially diversified away your own upside, but kept all the expensive fees.
Precisely. You guarantee underperformance. The math firmly shows that holding 3 to 6 funds is the absolute sweet spot. It balances the cash flow risk without killing your potential returns.
This all makes perfect mathematical sense. 20 to 30 uncorrelated stocks or 3 to 6 private equity funds. Find the sweet spot and stop. But I have a glaring question here.
Oh, well, what is it?
A massive contradiction from our sources that we absolutely have to address.
Let's hear it.
We started this entire deep dive talking about Peter Lynch. He coined the term diversification. He warned the world against it.
He sure did.
But when he was actually managing the Fidelity Magellan Fund, it is a documented historical fact that he held up to 1,400 different stocks at one point.
Yes, he did.
How is that not the ultimate hypocrisy? How can the guy who invented the warning term hold 1,400 stocks?
I know it looks like a massive paradox on the surface. But when you dig into the mechanics of how Lynch operated, it actually reinforces the core lesson.
Really?
Yeah. Lynch didn't hold 1,400 stocks for the sake of diversification. He wasn't buying them to create a safety net or to broadly mirror the overall market.
Then why on earth did he buy so many?
It was a byproduct of his relentless, active research methodology. Lynch practiced what he famously called the scuttlebutt approach.
Scuttlebutt approach.
Yeah. He believed you could find the best investments by paying intense attention to everyday life and doing extreme grassroots research. The classic example is Dunkin' Donuts.
Oh, I've heard this story.
Right. He loved the coffee, noticed the stores were constantly packed with loyal customers, went back to his office, looked at the balance sheet, and realized it was a phenomenally managed business long before Wall Street analysts caught on.
He was hunting for what he called 10-baggers.
Exactly. Stocks that return 10 times your initial investment.
Yeah.
And to find a 10-bagger, you have to be early, and you have to look at thousands of smaller, rapidly growing companies.
Casting a wide net.
Because his research net was so incredibly wide, he organically found hundreds of companies that met his strict, rigorous criteria for strong fundamentals.
So he didn't buy 1,400 stocks because he was terrified of risk and trying to hide in a crowd. He made 1,400 highly specific, well-researched individual choices.
He was an active manager on steroids, and he knew that in the aggressive hunt for 10-baggers, some of those smaller companies would inevitably fail.
Right, that's just the game.
But because his portfolio was built on intense individual research rather than passive safety, the math worked in his favor. For every one loser that went to zero, he had 5 or 6 massive winners that were doubling, tripling, or 10-bagging.
That makes sense.
His strategy was the exact opposite of blindly buying a massive, top-heavy index fund just to own a piece of everything. He understood the why behind every single share he owned.
So what does this all mean for you? Well, it means that whether you are running a multinational corporation and eyeing a shiny new acquisition, or trying to manage capital calls for a private equity portfolio, or just, sitting on your couch trying to build a retirement account on your phone, success is almost never about the raw number of investments you hold.
It's just not.
It's about the deep quality and the underlying correlation of those investments. If a new venture, a new stock, or a new ETF doesn't add a distinct, clear, uncorrelated value to your mission, it's just adding complexity.
It's adding heavy iron armor.
Exactly. Armor that is going to pull you right down into the mud.
And I want to leave you with a final, slightly different angle to mull over regarding all of this.
Okay, let's hear it.
We've talked a lot today about how ETFs and index funds are currently trapping people in diversification because of that market cap weighting, right?
Right, the top-heavy indexes.
So in a world where broad market index funds are becoming increasingly top-heavy and concentrated in just a few massive tech companies, you have to ask yourself a hard question.
Which is?
Is the ultimate safe passive investment actually just a hidden form of active diversification? Are you accidentally making the choice to concentrate your risk simply by trying to avoid making a choice at all?
Oh, wow. That is a fascinating shift in perspective. Doing nothing is still doing something.
Exactly.
Well, take a hard look at your own portfolio, scrutinize your business strategies, and make sure you aren't just wearing so much armor that you guarantee your own defeat. Thanks for joining us on this deep dive. We'll see you next time.